Thank you all so much for joining us this morning. And Scott, thank you so much for sitting down with me.
Thank you. Good morning.
We're in a moment that feels very pivotal for this market. And I think it's useful to just take a beat because in many ways your career reflects the entire journey that this market has gone on. Heading up the investment bank at Goldman, spinning out HPS from JP Morgan, bringing that back under the fold of another company, BlackRock. Scott, how did we even get to this moment, though, where private credit became the behemoth, the headline grabber that it is today?
Right. Well, good morning, and thank you for having us. And we're living in a moment right now where maybe one of the most significant events in the world for the last 50 years is happening while we're also talking about private credit. So it's a little bit hard to put that into perspective. But I think what's from my perspective, again, 40 years in finance. Been all over the world with Goldman and JP, and the Western capital markets are going through a real change and evolution now. As you've had sort of the post-financial crisis landscape really settle in, banks have shrunk. You've got some big banks still very involved in the capital markets. You've got some big, some of the people that were on stage here over the last couple of days. Insurance companies and others, and then you've got some fiduciary firms like ourselves and BlackRock and Ares was on stage. Those firms are really bringing private pools of capital to grow companies, and with that, there's not enough bank capital in the world to grow the economy, and particularly as governments have leveraged themselves, there's really just not enough capital to grow the economy, and I think you're going to see that. Wave has been very big in the U.S., very big in Europe, parts of Asia, Australia. I think that's going to continue over the next 30 to 50 years.
It's a good point because not only are governments very levered at the moment, there are these huge projects that they're undertaking, whether it be Europe wanting to be more self-reliant, be it the AI build-out in the United States. So just how critical of a pillar has private credit, has private capital become for these economies?
Yeah, I think that again, they're not with the capital expenditure that's going into both technology, AI, as well as the underlying infrastructure. You're not going to be able to do that without private pools of capital. And Dylan, who you just spoke to, is one of the smartest and most aggressive in that. And I think you've got to have people pull that together and help structure things in a way that optimize and make it efficient. So you want equity in that. In order to attract foreign direct investment, you need the capital that comes alongside the equity to help that.
You made the comment to me the other day that I thought was interesting, that not only is this change continuing, but the pace is accelerating. What does that mean if we zoom out 5 years from now? If the pace continues to accelerate, what does this market look like?
Other than our heads explode?
No, that's possible too.
No, I think that we are in a period where change is really evolving quickly, and I think that with what's coming with AI, and I know Larry Fink and Rob Goldstein wrote an article on tokenization and the impact of that. That's also going to change financial structure as well as technological evolution. So all of that is going to come here in the next few years. Most of the financial landscape was set up really after 1929, 33, 34 Act. Banks in the U.S. and the West formed around those structures, and a lot of the technological change it has the potential to really change that dramatically.
Well, as we laid out, you've invested in many moments of disruption, be it Goldman at the dot-com boom and bust, be it JP Morgan and HPS during the financial crisis. This moment of change right now, does it compare to the scale of those disruptions?
I think one thing you learn is every disruption is different. I think a few of the things that you have to watch, again, I was in Germany in 1990, so the wall fell in 89, 90, and then as you get into the 1999 buildup for the dot-com and then into the financial crisis as with part of JP Morgan, leverage in the system, you have to watch that. We've been very conservative with leverage in what we're doing. I think, those are themes that come out. Matching assets and liabilities and matching structures so that you don't have a liquidity mismatch. I do think what's different today, the banks are I think, very healthy. You heard Jamie Dimon, you hear other bankers talk. I think the banks have remade themselves after the financial crisis. Obviously, we recapitalized the banks in the U.S. In Europe, they've shrunk a bit, but they're very healthy, so that's a positive sign. And then I think the CapEx cycle that you mentioned is something that has put the economy in pretty good shape here. So if we are going into a period of disruption, I think those two things are at least positive to keep.
So where do the concerns of leverage in the system come from then?
Well, I think that a lot of the leverage has moved to governments. So you've seen Scott Bessent and others try to really make sure that we're growing the economy and that the world is growing to keep pace with that. And then you've seen the labor dislocation that may come out of technology. We don't know where that'll go. That creates political upheaval and can rattle financial markets. Right now, I think the financial markets are behaving, some would say pretty surprisingly, how we're managing through what is a pretty significant turmoil, obviously, in the Middle East.
Jamie Dimon, though, you mentioned them. He did say, along with the health of J.P. Morgan, he's worried about others seeing risky lending that echoes back to pre-2008. Do you not see any of that then?
No, I would agree with it. I would say, listen, Jamie has been a close friend and one of the best mentors and leaders I've seen. And I think whenever you see things, you want to tell your organization to look closer, make sure you're very disciplined, be a good fiduciary, be a good risk manager, and we all will have our moments. Everybody that has spoken at this conference will have their moments, and you just have to make sure that you're doing it better than the others, and trying to show the dispersion that will come out when you do have those cycles.
I guess what I'm trying to understand is if there is a disruption, where it comes from. Is it from government then, because they're over-levered?
Well, I think that for what we do, I think obviously private credit there has grown significantly. So we've grown from like 300 billion back when I first started, maybe in the 90s, to now what, 2 trillion, and I know Mark Rowan was quoting more like 40 trillion if you include all the private high grade. Anytime you have an industry that grows like that, there will be pockets where things are more difficult. I think that the areas that we're watching are smaller companies in the U.S. in particular. So if they're smaller companies, it's harder to deal with tariffs, it's harder to deal with labor and with rising interest rates. So there you may see some poor performance. That doesn't necessarily mean that creditors or lenders will lose money, but it may be more difficult. And then pockets of software, everybody's been worried about how will that play out. I think there was a lot of capital that was put in from very smart private equity and very smart institutional investors into software, really in the 21-22 vintage that was pretty highly priced, and that, as that works its way through the system now 4 or 5 years in, you may see pockets there. But I also think that the need for income, people want income in their portfolio, and they can get that in many ways. You can get that from the treasury market, you can get that from a bank, you can get that from high yield right now is pretty good. High yield has very little exposure to software. And then you can get it from private credit, where you maybe get more return and a little less liquidity. And so that, I don't see that going away. In fact, I see investors wanting more of that and wanting it from real estate, wanting it from real assets.
There have been some, and Bruce Richards among them from Marathon, now part of CVC, who will be speaking at this conference, saying that the issues with software harkens back to 2016, what happened in energy markets, that oil prices go negative, energy credit is an issue, and it has a wider spillover effect. If there is an issue with software and you start to see defaults pick up, are you concerned that it might have wider ripple effects, or do you see it as very confined to the sector?
Well, I think the comparison to energy is a little different, right? You had a commodity risk that is very hard to hedge. So we don't do a lot of commodity lending,
sure.
And that's a different business really and a different risk profile. I think on the software side, you will see, again, same themes, smaller companies, models that are easier for AI to disintermediate will struggle. Obviously, every owner of a software company will try to morph that. So I think it'll be more dispersed amongst managers. Some will have done more. And again, it may be as private credit was growing during that 21-22 period. There was a lot of activity. People were trying to grow their businesses, and there now may have some of those loans that they have to make sure are going to become due. And if they struggle, then those firms are going to struggle.
So if the pockets of weakness are smaller, mid-cap companies and software, does that have any other economic ramifications? I think especially of small companies in America being the biggest hirers among the population. If those are the ones that are in trouble, is that a problem for wider American markets and economies?
I think the pace of technological improvement and the productivity improvements feel like the U.S. economy is going to grow its way through this. And obviously, you may have pockets of labor dislocation that will be hard politically, and we all have to work to make sure. In my career, again, over 40 years, I've seen as we get more technology, we need more engineers, we need more people to do more things, and I still am cautiously optimistic that we're going to work our way in that direction. But it's certainly a big technological change, bigger than anything I think we've experienced.
So if it's a moment of disruption, the pace of change is accelerating, be it technology or Western capital markets. When there's dislocation, there's opportunity. Where are you finding that opportunity right now?
Well, I think the interesting thing, and with some of this change, there has been some volatility. You've seen it in the equity market pockets and in the credit markets, where maybe because of some of the concern, the opportunity set is getting better. We've spent really the better part of 17 years being pretty conservative, tried to stay low leveraged, and so in a moment where maybe there is some dispersion, that's going to create opportunity. I think we see opportunity for the bigger players. So part of BlackRock now, being a scaled player, we're running a business now about $400 billion of capital across a variety of different lending activities or financial activities. And in that, we're seeing both borrowers and LPs want to work with partners that can be reliable, where you can be fast with capital, you can commit to them, you can deal with complexity. And then on the LP side, they want to see, we're fortunate to have a variety of different places where we can show them, this is your risk return, this is what we have in high yield, this is what we have in private credit, this is what we have in solutions, and you can bundle that in a portfolio that makes sense. And I think those trends are accelerating.
What then happens to middle market players who not only can't participate in that, but have lent to the smaller companies that, as you say, might have issues?
I think there will, as there always are, there will be middle market players who do very well. And then broadly, if your business, again, in credit, what we've always wanted to have a very wide funnel. So half of our business is non-sponsor, half is sponsor. Most of the middle market players and a lot of the players focus only on sponsor lending. So that limits them to sort of, and when they're just doing what they see, that creates a little bit of a problem. If I'm just doing middle market and then middle market goes bad, that's likely to not go well for the portfolio. If I'm just doing software lending and that goes bad. So I think you really want, and people like Mike Milken and others have talked extensively about portfolio construction, conservative building of the portfolios. That's what's going to carry the day.
So you mentioned the integration now into BlackRock, getting that scale, announced late 2024, finished July 2025. How has that gone? What has integration been like?
Well, we left the other day, I think Mike Patterson and Scott French and I were saying we've worked as hard as we're ever working. Coming into a big organization is very exciting. I think, as I said at the beginning, BlackRock's footprint, and one of the things we wanted to get out of it was really the origination opportunity with everyone. And I had this a little bit at Goldman and JP, where we now, when any borrower in the world should want to talk to us about what can we do. That's working. That's taken a lot to really get going. And I think we're just in the early innings of that driving. I do think, and I think somebody might have said this on stage yesterday, the shortage is origination. in these businesses, finding good assets and then being able to structure them and deliver them into managed accounts for LPs in a way that they have low single name risk. So that part's been good. And then what we've done with creating a $400 billion boutique within BlackRock, if you will, I actually think we've streamlined it. Like sometimes in business, you take big things and put them together and simplify it. And I think we've really simplified it for both borrowers and our LPs in a way that, but it's been work, and it's going to continue to be, a fair amount of work, but very excited about it.
How do you see the existing BlackRock credit business? Because it does feel very different than yours. More middle market, mid-cap companies versus, as you say, the split you have tends to be more kind of large cap.
Right.
How do you make sure that you can meld the two? How are you thinking about that?
There's been very little, overlap. I think in the middle market business in the U.S., I think there's been a little bit of overlap, and again, that's been a business with the companies growing less quick that you have to really be very disciplined right now. So we've been doing that, and I feel good about the team. Mike Patterson, Vikas Kaswani have done a great job, trying to streamline and integrate that. In Europe, they had a middle market business that was pretty standalone and was very, very successful. I think that is also then people are able to say, hey, if I've got a bigger deal, I'm mining for my middle market. If I get a bigger deal, I get to do that. That gets to be positive, and you get those positive benefits of having many different pieces of business together. So
I do just have to ask, because there was one of the BlackRock funds, one of the BDCs that was marked down 19% to NAV. Right. Again, a legacy fund, not one that you brought in. How are you managing that right now?
I think that there are pockets where you have to take a look at what the portfolios are and really take a look at how to continue to evolve there. That's a traded BDC, right. So a lot of people don't know the difference. Some are traded public but non-traded, and then that's a traded BDC. So what you're talking about there is the portfolio took a mark, and then the shares are traded in the open market. And you just have to be a good fiduciary and a good risk manager. And in that one, we're trying to help continue to drive what's right for both the borrowers and for the investors.
By the way, I did do my homework. HLend, which is a non-traded BDC, you had your marks at the end of this year.
Yes.
And staying very steady there, marked on only 5 cents, very, very negligible. There have been other BDCs, though, that have reported that have seen some discounts to NAV. Is what we're seeing now, and you're talking about the risk management, is it signs of stress, or is it just a return to historical norm after a period of low rates and maybe easier returns?
Yeah, I think you're hitting on something that is hard for the press and hard for media to really understand. When you see defaults, you see things happen. We were in a period of very low defaults during when interest rates were very low during COVID. Coming out of that, you are returning to normal and getting to more of a 3.5–4% default rate. Again, what matters in credit is not defaults, it's losses. We've had a very good history and track record of doing that, of building big portfolios with very low losses, and we're super proud of the business we built. And again, I think as we see more dispersion, we're going to show how that performance and how that fiduciary focus, risk focus, low leverage will hopefully shine.
Sometimes though, returning to the mean can feel painful for people who got used to lower rates, especially as the industry starts to push into retail. Do those two projects come into conflict with each other, of trying to bring more outside capital in at a time that, yes, it's just a return to the norm, but you start to see defaults pick up?
Right. Well, you mentioned Jamie. I mean, Jamie did say, anybody can make a loan. Not everybody that makes loans will go well. That's true. We also have a group that focuses on, and if loans do go bad, we need to be able to go in and take over the company, be able to manage that to optimize the return. Not every firm has that. Not every firm has the scale to afford that or the talent to do that. And I think that's something that will differentiate people. If you're just saying, okay, I'm out, then you're going to have much larger losses, and that's not going to be good.
It feels like just even more consolidation, Scott. If you have companies, if we remember the mid-cap players, you said, yes, some of them will do well, but maybe they don't have the teams to take back the keys. They're already dealing with companies that are under stress. The consolidation that's underway, just how dramatic are we going to see this evolve over the next 5 years, let's say?
Well, it'll depend on performance, right?
True.
I think that back to what you were saying too, there were periods where I mentioned 21 and 22 where software was very hot, firms were growing their business and wanting to lean in, and there is a little bit of okay, we wanted to grow. I think most of the big managers are very good at managing risk, and the scaled players are going to continue to benefit from this period. I think when you have less scale and you're doing more niche-y, what do I see? I'm only seeing a limited thing. That's a tougher spot to be, and I think those players will struggle. But again, they can have a business that's small. It's not going to be what I was talking about in change, the restructuring of the capital markets and big pools of capital. That's a different game that they're playing.
Scott, I'm afraid we are going to have to end it there. Thank you so much for joining. This was a beyond fascinating conversation. Everyone, please join me in thanking Scott Kapnick.
Thanks very much.